Hello there, Andrew Marquis, themarquisteam.com cross-country mortgage, reaching out today with an informational video on loan assumptions as requested by one of my top real estate partners. So thank you for the idea and happy to chat on this a little bit and share some insight. So loan assumption is basically where a seller is selling their home, they have a mortgage on their home, and the buyer wants to actually take over that mortgage from the seller. So, kind of the obvious benefit of that in today's market is that interest rates are, high 5 to 7%. Interest rates, 2, 3 years ago were 2 and 3%. So if a buyer could take over a seller's mortgage at 2 or 3% versus paying 6.5%, they'd be thrilled. But there's a lot of shortcomings here and a lot of reasons this might not work for your given situation. And that's really the point of our video today. So conventional financing, which represents the vast majority of mortgage loans out there, this is Fannie Mae and Freddie Mac loans, typically don't allow assumptions. So that takes a lot of people out of the mix there. The loans that are generally eligible for an assumption would be FHA, VA, or a portfolio loan at a bank, right? Might have that sort of a feature, a loan assumption feature. So the first thing is if you're representing a seller, what kind of loan do you have on your property? Do you have an FHA? Do you have a VA? Do you have a portfolio loan? Let's call your loan servicing and find out if it is assumable. If it is, we can advertise that when we market the property. So again, I've got a loan at 3% on my house. I'm selling it. It's assumable. It has that feature. We checked with the mortgage lender servicing the loan. It has that feature. We can market that. Hey, you're looking to buy my house. I have an assumable mortgage. If you qualify for that mortgage, you have to prove credit worthiness. You have to go through the lender. They're going to check your credit, check your income, make sure you qualify for that loan. But the other important thing is you have to pay the difference. So you're buying my house off of me. It's $1 million. I owe $500,000 on my mortgage loan. You want to assume it at 2.5% interest rate. You have to bring the other $500,000 to closing. So again, assumptions sound great and they sound like a great option, and technically they are a great option. I just think that they are a lot of cases you're really not eligible because you don't have the money to bring. The loan doesn't have an assumable feature on it. You may not qualify. Say it's a VA loan. You're not a veteran. You can't get a VA loan. So again, there's a lot to it, but I think it really starts with let's check if the mortgage on the house has an assumable loan feature on it. And then if so, what requirements does the buyer have to meet to qualify for that loan? And then you can start to look at it as an option for buyers. So hoping this was a helpful video again on loan assumptions. If you have any questions, please reach out to my team or I anytime. And thanks for tuning in as always. Take care.